Ladies and gentlemen, good day and welcome to the Chemplast Sanmar Limited Q2 FY23 earnings conference call. This conference may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ramkumar Shankar, Managing Director. Thank you and over to you, sir.
Thank you very much and good afternoon. On behalf of Chemplast Sanmar Limited, I extend a very warm welcome to everyone joining us on the call today. On this call, we are joined by our CFO, Mr. N. Muralidharan, Dr. Krishna Kumar Rangachari, Deputy Managing Director, Custom Manufactured Chemicals Division, and FGA, our Investor Relations Advisor. I hope you've all had an opportunity to go through the financial results and investor presentation, which have been uploaded on the stock exchange website as also on our company's website. The unique challenges facing the PVC industry continued through this quarter. Our business continued to face headwinds in Q2 FY23 as well due to the zero COVID policies in China, rising energy costs due to the Russia-Ukraine war, and overall inflationary pressures. Slowdown in PVC consuming sectors in China due to their zero COVID policy led to PVC inventory buildup in China and continuous dumping into India. However, with the commencement of proceedings on possible safeguard measures, some reduction in the quantum of imports has been witnessed in the last couple of months. While the conditions have been extremely challenging, the strength of our balance sheet and the portfolio of products that we manufacture have helped us to fare reasonably well in this very difficult situation. We closed the first half of the fiscal with a flat top line and a double-digit EBITDA margin of 11% at a consolidated level. While the top line is flat, what is encouraging is that sale volumes have registered a good increase across products, showing the recovery of demand post the pandemic. Talking further about business environment and our outlook across product categories, the first half of the fiscal witnessed a sharp drop in paste and suspension PVC prices. While feedstock prices, I'm talking about EDC and VCM, prices also dropped, albeit with a lag. The benefits of the drop in feedstock prices will, however, be realized only when the stability is reached on PVC prices. This sharp and continuous fall in prices has had a significant impact on the EBITDA margins, which have dropped to around 11% in H1 FY23 compared to the 19% in the corresponding period last year. The margins are under pressure also due to increase in energy costs, which continue to remain high, with coal and natural gas prices on an upward trend. We believe that both paste PVC and suspension PVC prices are nearing the bottom, and with stability expected towards the end of Q3, we expect to see an upturn from Q4 onwards. As mentioned earlier, sale volume of all products witnessed an increase in H1 FY23 compared to the volumes in the corresponding period last year. Based on current trends, the custom manufacturing business is expected to grow at around 30% on the top line in FY23. Recently, we have signed a letter of intent with a global innovator to supply an advanced intermediate for a recently launched active ingredient. To cater to the additional volumes of the custom manufacturing business, we plan to increase the capacity in phase 1 itself and fast-track the expansion. We expect to achieve significant growth in this segment in the coming years. Overall, in H1 FY23, our specialty chemicals segment revenue remained more or less at the same level on a year-on-year basis. In the first half, the other chemicals business, comprising caustic soda, chloromethanes, hydrogen peroxide, and refrigerant gas, delivered a 61% surge in the revenues, led by growth in volumes of all products and a sharp increase in caustic prices, which are more than doubled on a year-on-year basis during the first half. Demand for chloromethanes is also steady. There have been a few capacity additions in the country recently, which could have a temporary impact on prices. However, we expect the prices to recover and stabilize once the market absorbs the additional quantity. Hydrogen peroxide demand increased on the back of improved demand from the paper industry. The outlook remains positive with rising prices due to the tightness in natural gas availability impacting supply of hydrogen peroxide in the region. On the suspension PVC front, our revenues were lower by 10% during the first half, largely due to the price drops. Sale volumes were 5% higher in the half year on a year-on-year basis. What is encouraging is that the industry demand for suspension PVC in H1 was quite strong. It was up 18% on a year-on-year basis. We expect that in 22-23, the industry demand for suspension PVC resin in India would revert to the pre-pandemic level of 3.3 million metric tons, which would be a 16% increase over FY22. Moving on to an update on our expansion projects. Work is well underway for the additional 41,000 tons per annum paste PVC expansion project at Kadlur. We have already received the required approvals. Detailed engineering has been completed and significant progress has been made on procurement. Construction is also progressing well, and we expect to commission this as per the schedule in the second half of FY24. The first phase of our multi-purpose custom manufacturing block is slated to be completed by Q2 of FY24. We intend to complete the civil work for the entire project in this phase. Effectively, phase 2 would take much shorter time to commission after completion of phase 1, as it would not require any additional civil work. With a greater visibility on new products, especially with the order win in this half year, we plan to increase the capacity in phase 1 itself to provide incremental volumes. Now I would request our CFO Muralidharan to share the quarterly financial highlights.
Thank you, Ramkumar, and very good afternoon to all the participants on the call. Chemplast Sanmar on a consolidated basis registered a drop in its revenue and operating profits for Q2 FY23 as compared to the same period in the previous financial year. The revenue from operations for Q2 FY23 stood at 1,194 crores, registering a drop of 29% on year-on-year basis. This was largely on account of a combination of lower realizations per ton and drop in volumes for our PVC products. Sequentially, we didn't see any major variations in employee costs and other expenses. However, on a year-on-year basis, other expenses have gone up by almost 27%, primarily on account of higher fuel cost. EBITDA for the quarter stood at 98 crores compared to 346 crores in the corresponding quarter last year on account of the recent explained. EBITDA margin for the quarter as a result stood at 8.2%. Our finance cost for the quarter has come down to 40 crores compared to 149 crores, which is a significant saving. This is primarily driven by reduction of debt using IPO proceeds and also the reduction in interest consequent to the upgrade in rating. Last year, Q2 also had a one-off impact, which was not there in the current year in the interest and finance charges. The PAT for the quarter was at 39 crores as compared to the PAT of 151 crores in the corresponding quarter last fiscal. Looking at the off-year numbers, revenue from operations was flattish at 2,606 crores as compared to the corresponding period last year, and EBITDA stood for the half year stood at 293 crores with the EBITDA margin at 11.2%. Net profit for the H1 FY23 was at 79 crores as compared to 180 crores in the corresponding period in the previous year. Coming to the cash flows, the company generated net cash from operations of around 300 crores in H1 FY23. We spent 115 crores for the purchase of property, plant and equipment during H1 FY23 with project capex accounting for significant part of it. As mentioned earlier, to cater to the additional volumes of custom manufacturing business, we plan to advance some of the capacity planned in phase 2 in phase 1 itself, which will lead to the project cost from phase 1 moving up from 260 crores to 310 crores. We have tied up the loans for the paste PVC project and partially drawn down the loan. We have drawn 80 crores during this quarter. We are in the process of tying up the debt for the custom manufacturing business, which will get tied up in the ensuing quarter. With a healthy cash balance of 1,400 crores, we continue to be net cash positive on a consolidated basis. With this, I conclude the presentation and open the floor for further discussions.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Yeah, good afternoon. Thanks, Ram and Murli, for that opening remark. I have a few questions. Sorry, I may stretch a little bit here. First, on the custom manufacturing. At the start of the year, we gave a guidance of 15%. Now we have inched it up to 30%. And the 15% more on the premise that we were running short on the capacity. What is driving this incremental growth? Because I don't think we have added any more material capacity. So that's number one. Number two, this new opportunity that we have just disclosed where we have won a long-term contract for a advanced intermediary for AI. Can you help us understand what is the total project size we are looking at for this product? How much incremental revenue will this bring? And what is the investment for this particular product? Number three, in general for custom manufacturing, it looks like things are working quite well for us. We have increased the capex guidance from 2.6 in the first phase from 2.6 to 3.1. Do you think more upside there possible with more effort from the company to drive that growth business? And what is really driving that business for us? So that's my first one. Thank you.
Okay. Good afternoon. This is Krishna Kumar Rangachari. With respect to the first question on capacity in the existing site, yes, we are out of capacity, but I have to say that the good chemical engineers in the manufacturing facility, we seem to keep finding some way to debottleneck or squeeze or sweat the assets. So the top line growth is driven by the fact that we're just figuring out to get some incremental volume on the products or the campaigns that we are running this year. So that's what is going on. On the letter of intent, unfortunately, we cannot give much details because of confidentiality reasons with the customer. But it is a significant development and a milestone. The customer is very bullish on the AI that they have launched. They expect it to be a blockbuster, and we think this will have a significant impact in terms of capacity utilization of our new production block. Anything else you want to add, Murli, on that?
Sure. This is also adding to our thought process in terms of increasing the capacity in phase 1 itself. Because as this AI itself will occupy significant part of the phase 1 capacity expansion that we are doing. So this we believe is a significant win for us. I think it will occupy significant part of phase 1 of capacity and will add materially to the revenue of the custom manufacturing business in the coming years.
And your third question was on more upsides and should we be doing anything differently. We have the pipeline that we have is fairly strong as well as quite broad in terms of the number of products that we are working on. And as Murli and Ram indicated, this is one of the reasons why we are advancing some of the capex investment, and we anticipate more investments needed down the road as and when the projects materialize. And what is driving the growth? It is basically the innovator companies in this space are looking for reliable partners outside of China and outside of Europe. China was a big factor, till 6 or 9 months back, and with all the issues now going on in Europe, they're also realizing that they would need a stronger alternate geography to source their material from. So hence the focus is on India, and as they look for partners there are not that many reliable partners, to meet the stringent requirements of the global innovators in terms of health, safety, and environment compliance. The strong ethics and the value system, related to maintaining their intellectual property, and companies with a track record of execution, and so that's what is driving the growth and the pipeline for us in this space.
Yes, and just to add to what Krishna said, with all these positives and with us putting steel on the ground, showing sort of our intention to put capex in this, is actually attracting a significant interest from the innovators, and which is resulting in a strong pipeline. And to your question whether there is upside to this, we do believe this is an area which has unlimited potential for growth. So we do believe that this is definitely an area for growth in future, and we would be looking to fast track growth in this area.
Thanks for that. Krishna, one just follow up on that, the letter of intent thing. Is it an innovation patent protected product, or it is a, because you said they expect it to be a blockbuster, that I believe it should be a patent protected product, right?
Yes, it is a new molecule that they have recently launched. So yes, it would be protected. It would be a patent protected product.
So it also means that have we worked on this product before this, or we got an entry post the commercialization of this product? At what stage we started engaging the customer?
So this, I think in prior calls I've said that the timeline on all these projects is anywhere between 18 to 24 months. This is something we actually started working almost 2 years back, and we have been on a development mode with the customer, and parallelly, they were going through some registration process, and which I think most of it is done from their end, and so this is, again, this product has already been launched commercially by the customer, so they do have a very limited supply chain for the raw materials, and now they are expanding the supply chain.
Fair enough. And any update on pharma side? Are we doing anything, or the action is more on the agrochemical side?
So we do have, currently we do have intermediates that we are supplying into the pharmaceutical end use. That is also an area of focus for us, and we are working on various projects in the pipeline for that. But that, again, as you may be aware, the pharma CDMO is slightly different when compared to agrochemical, and more longer lead times, as well as more. And you need to have a much more broader pipeline in terms of the number of projects that you need to work on to get to a commercialization in a stage gate type approach. So, but we are working on the pharma side.
But we have few products on the CDMO on the pharma side.
Yes, absolutely. Both now and historically, we've always had capabilities as well as chemistry. By capabilities, I'm saying both chemistry as well as the regulatory and the quality assurance and quality control that's required on the pharma side. So we have the capabilities, and we do have customers in that space.
But we don't have a CGMP plant, right? So that will be required at some point of time for us to scale up the pharma, correct?
So CGMP is required only if you are making the actual API. So two answers to that question. One, what we have now are intermediates which do not require a CGMP type facility. The second is, in the past at the site where we are running this business, we do, we still do actually have the capability to make APIs also. So we are very familiar with what the requirements are in terms of CGMP requirements to make API. It's not new for us if it comes to that. But we will do it only if the customers want an API from us.
No, my question is because we were more strong on the signation point of. Yeah, this last one. So on the signation side, we were very strong, right? And I thought signation had a much more stronger application on the pharma side than agrochemical side. Am I missing anything here?
No, not really. No, signation, your signation it's useful both in both those end markets. So I mean, again, so we do signation for pharma as well today. So, but I'm saying we are in the intermediate space. We don't make any APIs for our customers in this space right now. That's what I'm trying to say. But I'm saying that we have the capability, to make APIs if we need to.
Great. Thanks for all the answer. I do have a lot of questions on PVC, but I think the operator want me to come on the queue. I'll get back on the queue. Thank you.
Thank you.
Thank you. We have the next question from the line of Ahmed Madha from Unifi Capital. Please go ahead.
Thank you for the opportunity. I'd like to probe more on this topic of custom manufacturing as Sanjay was discussing. So first part is, so earlier I think we had 350 crore or 340 crore capex plan combined both phase 1 and phase 2. Now that we are doing 300 crore in the phase 1, what are thoughts on the phase 2 of capex? How should we look at it, and what are the timelines for the same?
You're right. Actually, we are fast-tracking the capex and incurring significant part of it in phase 1 itself. Obviously, the phase 2 is not going to get restricted to the balance 40 crores or 30 crores left. It will definitely be rather than that. And we are evaluating the pipeline and options and looking at fast-tracking phase 2 as well. We would sort of announce it once we form up a view on that.
Got it. And just to understand the letter of intent which we have signed, so does this product will form significant portion of the capacities which we are building? How should we look at it? What sort of diversification we will see in product portfolio? Can you throw some light on that?
Yeah. So we expect in steady state this particular molecule where we have signed a letter of intent to almost occupy 1/3 of the capacity in the new production block we are building. So that way it is a significant opportunity, and as I explained, the customer is very bullish in terms of the demand both for the intermediate as well as the demand for their molecule. So hopefully that gives you a flavor for the magnitude of this.
Yeah, got it. But then, say, for 1/3 of the capacity, say we have already made the commitments, but for the balance part, does this mean that we are already in a discussion in advanced stage, or it is just that we'll put up capacity and then slowly we'll work on the products and with customers? How will the ramp up look like?
So okay. As I explained in the previous question, this particular molecule for which we signed a letter of intent, we have been working for almost 2 years. So we have a number of such products that are in the pipeline, either at similar levels or at different levels of commercialization or qualification. So you would have to wait for us to come back to you in the future in terms of how those molecules are moving in the pipeline. So it's not that we will start working today to fill up the balance capacity. We are already we have enough in the pipeline that would ensure that the capacity in the new block is occupied when it gets commissioned.
Also, we are also parallelly working, like Krishna said, there is a strong pipeline, and we are parallelly working on commercializing some of them. And we have not talked about the individual products, and we have talked about this area because this we felt is a significant part of the capacity, so we are highlighting it. Doesn't mean that we are leaving the other capacity unaddressed. We have sufficient pipeline to take care of the other capacity as well. So that is in various stages of commercialization, and that's progressing as per plan.
Oh, okay, makes sense. So now moving to the other part of the PVC and suspension PVC. So if we look at the EBITDA which we have earned, and if we sort of adjust it for the inventory loss which we took for Q1, we have virtually earned a negligible EBITDA or contribution, or whatever we like to put it, on the paste PVC and suspension PVC part. So now going forward, or as of today, how do the spot spreads look like, considering that PVC prices have corrected more than 50%? The raw material prices also corrected, but then there is competition from China, and there are a lot of other factors as well. So how do the spot spreads look like, and where do we end here Q3, Q4 in terms of the spreads which we're talking about in terms of $250-300 a ton? How does that look like now?
Okay. It's a very valid question. Actually, if you see the PVC prices, they had run up pretty sharply over the last couple of years till about October 2021. And thereafter, they had come off a little bit, but the sharp drop in prices really happened from around March or April of this year. And if you see the number and quantum of price drops, there have been, from April onwards, there have been more than 12 drops in suspension PVC prices alone. And this kind of frequent price drops obviously affects the sentiment. Unfortunately for us, this also coincided with the monsoon season, which is typically a weak season for demand for suspension PVC in India. So this was a combination of both that weak seasonal demand as also the fact that pricing sentiments were so negative. And that kind of fed on each other. The margins have, in this kind of a situation where prices keep falling, unless people are absolutely sure that the price drop has stopped, the buying sentiment is also then weak, and people buy only for their immediate need and not for inventory. And today, across the PVC channel, the inventories are running low, and people have still continued to buy only for their immediate need. Because the perception is that the bottom, while we are close to the bottom, we are still not yet completely there. So to address your specific question, we believe that given the cost price dynamics, we are close to the bottom, but it will take maybe another month or so for us to see it, and therefore by end of Q3, we will have that stability come back. So Q3 will continue to be a difficult quarter as far as margins and prices are concerned on PVC, and we will start seeing once that stability in prices comes back, and if it comes back as we expect by around December, Q4 should see the reversal.
Okay, can you quantify the spread number? Earlier, I think you have even explained the contribution margin per ton, even monthly wise. So can you quantify what sort of spreads or contribution margin we are running now?
Currently, the margins are roughly around $180 level. CFR India prices are somewhere around $825-$830, and VCMC for Asia is around $640 to $650 level. So roughly around $180-$190.
Okay. So is this fair way to understand that?
Request you to kindly come in queue for follow-up questions, sir.
Sure. Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants also request you to kindly restrict your questions to 2 per participant. We have the next question from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir. Good afternoon. Am I audible?
Yeah, please.
Yeah. So, just as a follow-up with the previous participant's question, I just wanted to understand what is the outlook in terms of the pricing, and how is the global dynamics playing out, the China factor, and what we hear from other players that even US prices demand is weakened and that is having a negative impact on Indian prices, on the resin prices. Could you share your thought, please?
Let me address the demand part first. The demand for PVC in India is actually strong. This first half has seen a 17% year-on-year increase, and we expect the full year, like I said in my opening remarks, to be back to the pre-pandemic level of 3.3 million tons, which is 15 to 17% year-on-year over FY22. Therefore, the demand in India is quite strong. It is a fact that demand in, for instance, the US has come off a bit, largely due to higher mortgage rates. But there again, if you see the earnings calls of some of the large PVC producers in the US, they are pretty confident that this will come back by the middle of Q1 of their calendar year, which is the January-March quarter. The biggest problem has been in China. We've been highlighting this. In fact, you would appreciate that as a company, we were the first to highlight this and very transparently recognize an inventory write-down as well in Q1 itself. And this is largely due to the zero COVID policies of China. Around 75% or so of their capacities are in the west of the country, and 70% of their demand is in the southeast. And while all the COVID-related lockdowns have been concentrated, unfortunately, in the southeast of China, and therefore the demand for PVC has come down while the production continues. And that is what has led to this entire sharp drop in prices starting from around March or so. We believe that it is getting close to that end in terms of the quantum of the price drops or the frequency of the price drops, largely because costs will also kick in at this point in time. And beyond a certain level, prices cannot go down. So the Chinese producers may also, ease off a bit. So the recovery in demand in China is what will drive the prices up in the future. Now, when that will happen is the question, and that is dependent on the reversal of zero COVID and the opening up of the Chinese economy. But the stability is, we expect it to come by around December this year.
Okay, so this Chinese factor, so is it still continuing to be a major issue, or are things stabilizing in terms of the domestic consumption in China?
The expectation largely was that post the Communist Party Congress that happened recently, zero COVID policies would be eased off and life as normal would return. But there is still some question mark on that. So it is not very clear at the moment when that would happen. It may happen in a couple of months, or it may take a quarter or so. But obviously, the fact that the economy in China is being badly hit by this, and there is some discomfort, to put it mildly, in society as well there. Maybe there is a lot of expectation generally around the world that there could be some easing off. We have to wait and see.
Okay. And one last question. Yeah, please go ahead, sir.
Yeah, the one thing that I would like to reiterate is that the medium to long term expectations on the PVC demand supply balances, those continue. So this is something that is a very peculiar one-off kind of a situation. But once this is resolved, we still are very bullish on the PVC industry and the fact that the capacities are not going to the extent to which demand is expected to go.
Okay. And so just this follow-up, you mentioned that this first half we have seen 17% growth in the PVC demand in India. So could you share what is the demand number for FY22 and what sort of number you are looking for FY23 PVC demand in India?
FY22 was 2.83 million, and we expect that this will go to 3.3 million in FY23.
Okay, and 21, how much was this number, sir?
2.83 million tons. Oh, in 21 it was 2.76 million.
2.76 million, okay. Great, sir. Wishing you all the best. Thank you.
Thank you, Rajeev.
Thank you. We have the next question on the line of Yogesh Tiwari from Arihant Capital Markets. Please go ahead.
Thank you, sir. Am I audible?
Yes, please.
Yes, my first question is on basically on PVC. So, sir, can you quantify the Chinese imports? What would be the monthly run rate for Q2 Chinese imports for PVC compared with that in October?
This is the operator. Sorry to interrupt. Would Rakesh you kindly go on the handset mode because your audio is not very clear, Mr. Yogesh.
Sure.
Yeah, am I clear now?
Yes, much better.
Yes, sir. So just the first question is on the Chinese imports for PVC. If you can quantify what would be the monthly run rate for Chinese imports in Q2 versus that in October.
Okay. Actually, October numbers are not yet have not yet been received because we depend on officially released data. But if you look at the last few months of imports from China, in April we received something like 67,000 tons from China. In May, India received 90,000 tons. In June, it was 98,000 tons. In July, it was 76,000. And then in August and September, they've fallen off to 32,000 and 20,000. This is largely to do with the commencement of safeguard measures investigation by the government based on a representation by the industry. That is an ongoing process, so there is some drop-off in the imports from China.
Thank you, sir. And sir, the other question is on other chemicals. So it looks like that realization in other chemicals has declined on a quarter-on-quarter basis. So if you can help us understand what product it is, basically chloromethane, caustic soda, which product is actually leading the decline?
Okay. Actually, caustic soda has gone up, and metron gas, refrigerant gas has also gone up. Chloromethane, I'll rephrase it. My apologies. Chloromethane is from around 60,000. I think it's around 52,000. So it's not. None of these have really gone down significantly. Caustic soda has again hovered at around the 52 to 56,000 rupees per ton. And in fact, it is in October again. It is back at the 56,000 rupees a ton. And the rest of it, it's pretty much stable around maybe give or take another 2,000 rupees or so here or there. But they are more or less stable in the other chemicals.
Sure, sir. And lastly, one on the other chemical itself, there has been an increase in volumes on a quarter-on-quarter basis, about 10%. So this will be driven by what would be the drivers for it, the volume increase?
The caustic volume has gone up this quarter compared to the previous quarter.
Okay, sure. And if one question, if I can just come in, like for specialty chemicals, like Q2 seems to be a very strong quarter, like 20,000 tons last year also and this year also. So is there any seasonality in specialty chemicals for Q2?
Not so much. Actually, paste PVC doesn't have the kind of seasonality that suspension PVC has. This is pretty normal. We have pretty much round the clock kind of sales for paste PVC.
Okay, because Q1 we had about 14,000 tons in specialty, the volume. So
that was because of some stock that was built up. Part of it has been liquidated in Q2.
So in Q1, actually, like Ram was also explaining earlier, when the prices were falling, people were holding up purchases to some extent, which resulted in lower volumes in Q1. Otherwise, generally, unlike suspension PVC, we don't have a seasonality, so much of a seasonality in paste PVC or specialty.
Sure. Thank you, sir. That's all from my side.
Thank you. We have the next question from the line of Dhaval Shah from Direct Capital. Please go ahead.
Hello. Yeah. Hi, sir. Sir, with this volatility in the PVC prices, how will this impact your decision-making process for the next round of capex? Because we have been interacting since past 1 year now. The scenario and the commentary by the management was much different, and we were expecting a global demand-supply mismatch to sustain for a long time, and there was a lot of positivity around the PVC demand supply. and now we are at this juncture. So how will this impact the next leg of expansion in the PVC? Yeah.
No, as I said just a little while back, also we continue to be bullish on the medium to long term prospects of PVC. The demand supply structure of the industry has not changed at all. What has happened over the last few months is really this one-off event revolving around COVID. And if suddenly you find a country which accounts for around 40% of the global capacity, their demand drops off suddenly and then they start exporting to the rest of the world. Obviously, that will have an impact on prices around the world. It is not just in India. The prices have been affected around the world. But this is not something that is expected to continue. China's demand will come back. Their economy will come back once the zero COVID measures are eased. And when that happens, we believe that the situation that we have spoken about in the past will continue to reassert itself. So PVC demand will grow faster than PVC supply will, and that will lead to a tightening of the capacity for PVC. This will play itself out. I don't think we should let the immediate short-term change the views on the medium to long term.
Okay. So then about the next level of expansion in the mentioned PVC business, by when can we expect any decision on the same?
As we've always been saying, we don't have any final decision. We've not made any decision on the expansion of suspension PVC. We have focused on expanding our specialty businesses, which is why you're seeing the fast tracking of the expansions on custom manufacturing business, as also the expansion of our paste PVC business. We have already well into our projects on both of those, and we are on track to commission those. Suspension, we don't have any investment plans as of now.
Okay. Yeah. Thank you, sir.
Thank you. We have the next question from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. A couple of questions. First is on PVC, sir. I presume there has been some safeguard duty which has been proposed. Can you please highlight at what stage of the process the government is in, and if there has been industry representation on the sort of duties, quantum of duties, if you could please highlight that. That's the first question, sir.
So we are not really looking at a safeguard duty as such. What we have as an industry, what we have asked for are safeguard measures. It could be quantitative measures or quantitative restrictions. And this is largely to do with the quality of the product that is coming into India. As a country, since we need PVC to be imported, it is not that we are saying there should be no imports. We are only saying that poor quality products should not be imported into India. This is being taken cognizance of, and the government has started its investigation and its due process. It is too early for us to talk about where it is and when it will fructify, if at all, and all of that.
Sir, this is only for PVC, right? And sir, when we say quality, is there any particular, can you explain it simplistically, how should one look at it, say for K63 or any other grade of resin, K67?
It is basically to do with the residual VCM present in the product. So, we are talking about any product in excess of 2 ppm of residual VCM. There should be quantitative restrictions because all of what is produced within India is well below that. And that really is the entire focus of this measure.
Perfect. That's very helpful. Sir, my second question is, if you could please highlight what the PVC prices are in Southeast Asia or China right now. And if you could just provide some clarity on the duty structure. I think, are the current duties at around 11% if the imports are from China? And there was an ad hoc number of around $147, which I think was taken off in early Feb or mid-Feb. So just wanted to understand the import parity math on resin.
China's prices in China are around $780. For instance, a Taiwanese producer is quoting, when he quoted $830 per ton to India, they had quoted $780 per ton to China. As far as duties are concerned, there are today no anti-dumping duties on PVC. The only duty is the basic customs duty of 7.5%, which will effectively be 8.25%. 7.5% is the basic customs duty.
Okay. And sir, how much will be the freight from China to India if one has to assume on an import parity basis, if I have to calculate for, say, 1 ton of PVC, so $780, 7.5, you indicated $8.2. And what is the freight? Should one assume $100, $150, $200? What should that number be?
Today's freight, because of the very muted level at which the Chinese economy is operating and the fact that there is not much of cargo moving in or out of China, it is only at around $40 a ton. But just about once that economy comes back into full operations, I presume that this could go up.
Sure, sir. If I just last question, sir. If I just put in the numbers, what you indicated, $780, 8.2%, $40 of freight, it essentially implies on an import parity basis, landed price should be at 70 to 73 rupees. This looks pretty far from where the current PVC resin prices are. Does it imply that there is far more downside?
This is the point I was saying. In fact, after September, in October also there have been a couple of price drops. So we were talking about the current position, the current price levels that we see in the market, which is why I said that Q3 will be challenging again, and it is only towards once the price stability reached by the end of Q3 that you will start seeing the recovery and reversal in terms of margins.
Sure. Perfect, sir. Thank you so much for the answers.
Thank you.
Thank you. We have the next question from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. So first question is on the custom manufacturing. So the last quarter we had indicated that phase 1 will be commissioned in Q1 of FY24, and now we are seeing Q2. So this is purely because there has been a revision in terms of the capex, or are there any other delays because of which it has been postponed by a quarter or so? Thank you.
We had indicated it will be commissioned by H1 of FY24, and it still holds. Even with the increased volumes that we are looking at, we'll still commission it by H1 of FY24. There is no change in the plan.
All right. Sorry, my bad. So second question is on the, again, custom manufacturing. So what kind of product pipeline usually we have? What are the product commercialization schedules that we expect over the next maybe 2 to 3 years? And generally, how much time does it take from an inquiry to commercialization perspective?
Sorry to interrupt. Mr. Rohit, your voice is breaking in the between. If you could go off the speakerphone once.
Yeah, is this better?
Yes.
Yeah. So on the custom manufacturing front, in terms of product pipeline, the product commercialization schedule over the next 2-3 years, and generally, how much time does it take from, say, inquiry to commercialization? Thank you.
Okay. Yeah, this is Krishna here. So typically it takes anywhere from 12 to 24 months from inquiry to commercialization. And as we have indicated in the past, we have a number of products at various stages of commercialization, and we will keep giving you updates as and when each of these get closer to commercialization. Just like we have announced today on Friday regarding signing a letter of intent for one of the projects we're working on. All I can say is the pipeline is very healthy and moving forward at fairly quick pace with respect to qualification and commercialization.
Also, so with the fact that we are advancing the capex, part of the capex from phase 2 to phase 1, obviously sort of is due to the fact that the pipeline is healthy and we are looking at capacity for additional volume. So that demonstrates our confidence in terms of our pipeline and the phase of commercialization.
Right. Got it. So just one last question, if I may have. In terms of cash balance on our balance sheet, we currently have a strong balance sheet. So are there any plans of going in for any inorganic initiatives, coupled with whatever capexes that currently are ongoing on organic basis? Thank you.
As far as the cash usage of cash is concerned, broadly, if you look at the cash, we are carrying around 1,400 crores of cash by September end. Of that, almost 850 crores is with the subsidiary, which is CCBL, and 550 crores is the holding company. And out of the 550 crores, we have already commissioned project creations of 750 crores, of which requires equity deployment of around 300 crores. So there is some surplus left. We would like to keep some buffer with us, but at the same time, we are also looking at number of growth opportunities, specifically on the specialty side. If you ask us anything specific inorganic, we don't have anything to say today in terms of on hand to say that we have something on inorganic that we want to do. But at the same time, we are a company, we have grown over time through organic as well as inorganic means, so we can never say never. So broadly, yes, you are right, we are sitting on significant cash, but the part of the cash, large part of the cash is with the subsidiary. Holding company is already deploying cash in specialty growth, and we are more focused on growing the specialty business primarily on the custom manufacturing side. And as far as other opportunities, as they emerge, certainly we would like to look at capitalizing them if we believe there is synergy and growth in those opportunities.
Right, sir. Got it. For answering all the questions, and best of luck, sir.
Thank you. We have the next question from the line of Krishna Kumar Srinivasan from Lion Hill Capital. Please go ahead.
Hi. Good afternoon, Ram Kumar. You just mentioned a few things in terms of overall long-term demand situations and also China opening up. Considering the medium-term optimistic outlook and the cash that we have, would it be prudent to kind of stock up on the materials and probably build up stock, which probably can be used up going forward when the demand recovers sharply in the market? What would be your policy on such stocks?
Thanks, KK, for the question. It would be difficult for us to build up stocks, and maybe not so prudent to do that as well, because especially in the immediate short term, with the prices falling, any additional stock that we have will hurt us in terms of inventory losses. But even otherwise, the policy that we have built up over many years of experience is that we operate with wafer thin stocks on finished products. We normally have only around 4 or 5 days of production as inventory. And in terms of our feedstock as well, we buy it with a very tightly controlled supply chain, and the tankages determine the kind of stock that we can have. So there is not much of leeway there in terms of feedstock as well.
Thanks a lot, and all the best for the future.
Thanks, Kate.
Thank you. We have the next question on the line of Nitin Tiwari from Yes Securities. Please go ahead.
Hi, sir. Thanks for the opportunity. Most of my questions are answered. Just clarificatory ones. So you mentioned during your presentation and afterwards that in the longer run, you still see that the fundamentals for PVC market are intact in India in terms of demand and supply. So how do you see this evolving in terms of the capacity expansions that have been announced by your competitors, and some of them are pretty large ones. So correct me if I'm wrong, we have currently 1.5 million ton of production capacity in India, whereas the announced production capacity over next 2 years is to the tune of almost 3 million tons. So we would practically be reaching about 4.5 by the end of 2 or 3 years. So then how do you see the pricing and the demand supply dynamics shaping up once this pans out?
See, the current demand for suspension PVC in India is around 3.3 million tons. That is what we expect it to be by the end of this financial year. and the current capacity is around 1.5 million tons. In 4 years' time, this demand is expected to grow to anywhere between 4.5 to 5 million tons. And the expansions that have been announced, they will come in phases. They will not all come together, and they may take 3 to 4 years. And so we need to see how many of these projects, which ones will come when. So even assuming that all of them come together by say 2026 or 2027 is when the final, all the capacities, all the phases in full will come in there, we will still be short in the country by 1 million tons or so. So I don't believe that there is anything to worry about in terms of demand supply within the country because PVC is really growing well. In fact, it is very underserved within India. Our per capita consumption is hardly 2.5 kilos as compared to maybe Southeast Asia at 4.5 to 6 kilos. China is well above 12, and the rest of the world, the developed world, would be maybe around 16 to 20. So there is a lot of scope for demand for PVC in India to grow. Today it is constrained by lack of availability. When more capacity comes, we believe that the demand will grow even faster. So we do not foresee any threat because of this new capacity. We in fact welcome this.
Right. Thanks for that explanation. The reason I asked because again, correct me if I'm wrong. Globally, we are oversupplied as far as PVC capacity is concerned. So far, the dynamics within India was such that we were underserved. There was under capacity. So would you say? Do you believe that there could be any pricing pressure going ahead, given that now India would also be perhaps be reaching almost at par capacity as far as at least near-term demand is concerned, with these capacities coming up? So of course I understand that they're going to come up in phases, but as these capacities keep coming in, they will be closing the demand supply gap that exists. So do you think that it has the potential to put pressure on pricing in any way?
No, that's what I was trying to explain. Basically, as these capacities come on in phases, you would on the other side see the demand also going up every year. So by the time these capacities are finally in, you would have the demand having gone up to maybe 4.5 or 5 million tons. And that could result in the gap between demand and supply still at a very healthy million tons. That is, demand will be in excess of supply. So we do not believe that the situation in India is going to get tight in terms of availability, so long as the normal, demand pattern continues. And we are confident that it will continue for all these reasons that I said. One is the per capita consumption being low, and the fact that there is still so much space for PVC consumption to grow in India. The fact that in irrigation, less than 50% of the net crop sown area in India is still non-irrigated. Less than 50% is irrigated. More than 50% is still non-irrigated and dependent on the vagaries of the monsoon. And that is something that gives a huge opportunity for PVC pipes. And then in the non-agri sector as well, with so many new houses, the government-driven housing program, the smart city program, and all of that, you would find a lot of PVC consumption being required. And of course, for water, drinking water, the Nal Se Jal program, even for that, there's a lot of pipes that would be needed. So all of these programs from the micro level and from the macro level, we're talking about the per capita consumption. There is enough confidence being generated that the PVC demand will continue to outstrip PVC supply within the country, even with all these new capacities.
Great. Thanks for that clarification.
Yeah.
Thank you. We have the next question on the line of Ranjit from IIFL Securities. Please go ahead.
Yeah, hi sir. Thanks for this opportunity. So I have two questions. Firstly, on the balance sheet front, so we have net cash. At the same time, we also have a sizable debt on the balance sheet. And I believe that the cash and the large portion of the debt is sitting in the CCVL. So just wanted to understand the thoughts behind carrying this debt on the balance sheet. Do we intend to pay this off? What's the thought process? And also about the cash that is lying, what is the policy of deployment? We do it in the debt or the mutual funds? That's the first part. Thank you.
Sure.
As far as the debt that we carry in the balance sheet, we do believe that debt is an integral part of capital structure. So we would like to retain the debt and then pay it over the period of time as it matures. And as far as the cash in the balance sheet is concerned, like I explained earlier as well, we have 1,400 crores of cash, out of which 550 crores is in the holding company and 850 is in the subsidiary. And we don't deploy in mutual funds, we deploy only in bank deposits.
So what's the repayment schedule of the particular debt on the balance sheet in the CCBL?
It has three components. The significant part of the debt runs till 2030. There is one small 150 crores which gets repaid in another 4 years' time.
Okay, sir. Thank you. And the second on the CSM front, so all the capital that is we are deploying is going to generate revenue, or there is also an element of backward integration into that?
No, this is basically CS, the custom manufacturing business. It's primarily revenue generating capex. We are adding capacity mainly to take care of the pipeline of products that we have and the incremental volume of orders that we have.
Oh, sure. Thank you, sir.
Thank you.
Thank you. Due to time constraint, that was the last question. I would now like to hand over to the management for closing comments.
Thank you, everyone, for joining us today on the earnings call. We appreciate your interest in our company, and if you have any further queries, please do not hesitate to contact SGA, our Investor Relations Advisor. Thank you very much, and have a pleasant evening.
Thank you. On behalf of Chemplast Sanmar Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.